Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Hello, DealQuest listeners. Corey Kupfer here. This is a solo cast, and I'm going to be talking about something called a SPAC, S-P-A-C, which you may or may not have heard of, but it's the biggest thing that, looking at 2020, looking back at 2020, it is a vehicle that became very, very hot. And for some folks, you might have heard of it, some haven't, but I think it's interesting to understand what SPACs are, what they're used for. And let's start off with, what does a SPAC stand for? SPAC. So it's a special purpose acquisition company. So the difference with a SPAC is that there's a few things. Number one, it is a public company. So somebody registers a company to become public, just like on public offering, like any other company. However, this company has no operations whatsoever. All right. It is a entity that is formed for the sole purpose of doing acquisitions, and it goes public prior to doing a single acquisition. So it raises money for the purposes of acquiring another company or companies in the future. And that company or companies are not designated in any way. So, let's say it's going to, in most cases, acquire a company. Nobody knows who that company is going to be. And the promoters, the founders, the people who are putting together the SPAC may have an idea of a target, but they may not actually. So they're raising money on what some people, another name for them have become blank check companies. Why a blank check? Because you're essentially investing in something that you don't know where it's going to end up. Now, why would anybody ever do that? Well, listen, if you look at most investors who invest in private offerings, let's start out with private offerings, right? And then, at the time, many of them will say, for example, your venture capitals, your sophisticated angels, many of them will say that, one of the biggest things they're investing in is management. And, although obviously in those cases there is a difference in that they do get to vet and look at the idea of the company that's being pitched, they also know that that company's probably going to evolve and pivot and who knows what it's going to do. So, there is that difference, though. They get to evaluate the actual idea. But a big part of why they're investing often is in management. So in a SPAC, you're definitely investing in the management team and the founders and the promoters, because you will think, that you'll have confidence that they're going to make the right choices on making the right acquisitions. Pre-acquisition, I should say this, not pre-acquisition. In most cases, the SPAC has 2 years, right? And this all depends on how it's drafted. But in most cases, it's become pretty standard that the SPAC has 2 years to make an investment, or else the investors get their money back with interest because the money is put in an interest-bearing account. So there's not a lot of risk of the lack of an investment being made, because you do get your money back and you do get interest on that money. Maybe there's an opportunity cost, there, because you could have invested that money differently, whether it was in other, companies or maybe in higher return investments. That's not too bad. The real risk is involved is, what kind of company do the promoters end up buying, and does that work out? Now, just to give you an idea of what is happening with these SPACs, in 2020, there was a record 78 billion. This is Microsoft News has reported, record 78 billion raised in the US. And actually they're quoting Bloomberg. So those numbers come from Bloomberg. And that exceeds the combined total of SPACs in all the previous years ever, and made up about 45% of the 2020 IPO volume. So of all the companies that went public, right, 45% of them are these blank check, SPAC companies. So that, that's amazing. I have some other stats, if I can pull them here, on the difference between, what has happened in past years, because they started kicking up in 2019. They had been around again for about 20 years. In 2019, there were 59 SPACs that raised $13.6 billion. So if you look at the $13.6 billion versus $78 billion in 2020, you're talking about, what is that math? That's, more than 5 times the numbers. In fact, it's almost 6 times, the amount raised. Plus 2019 was a big jump off from prior years. So it's become a hot vehicle. Now, why has it become such a hot vehicle? Well, there's a few reasons. Number one, investors are looking for returns. Interest rates are low, parking money on the sidelines, putting it in safe investments like that, getting almost no returns. And obviously, the stock market's been doing good, but investors who invest in SPACs are people looking for higher returns. This is money that maybe in the past would have gone into hedge funds, but they haven't performed quite as well, over the years. There's some similarities, although hedge funds are normally private. And also hedge funds often, make multiple investments in different things. This is a public entity that's for single purpose, single investment. This is one other similarity with a hedge fund is that hedge fund promoters often take 20% off the top, or, the classic structure is what they call 2 and 20 in a hedge fund, which means that they take 2% on the assets that they hold, the money they've raised, plus 20% of any profit. In a SPAC, the 2 is usually not there, but the 20% of the upside is, has been the classic promoter piece or founder, piece in a SPAC. Although, it's been interesting because if you read a lot of the press and you study it in 2020, it's become so competitive because there have been hundreds of SPACs that have been formed. And a lot of the promoters are sort of competing for money, and they've gotten very competitive and changed their, they're taking less, they're making more of their returns contingent upon results. The 20% is getting squeezed in various ways. They're getting sort of warrants on, on other deals. And so there is some competition there that's pushing down the promote, as they call it. So what the founders get is, often a promote. It's the piece that they get off the top for putting the thing together. There's been some squeeze on that, with the competition that's been going on. A lot of big names in SPACs, the big investment banks that you've heard of, Credit Suisse, Goldman Sachs. A number of those, banks have been very active in forming these SPACs. Citigroup, Credit Suisse, I think it was the number one. Citigroup was second. Like I said, Goldman's involved. So the low interest rates. And by the way, I talked about the fact that the market's been doing well. Well, you can invest directly in the market, but what's also happened here is that's been a reason why so many of these SPACs have been formed and taken, and again, they do IPOs, right? So, the market is strong. So the valuations are high, even for these SPACs. So they can raise a lot more money on these blank check companies right now. What are the risks of that? What does that mean? Well, obviously, if the market cools, that's a problem. If the market goes down and there's less, valuations are lower, then SPACs will become less attractive. Certainly, the SPACs that raised all that money, if they don't make the right investments, or if they make investments now in companies, and then the market goes down, that could be a problem. And as interest rates go up, which may not happen anytime soon, then the comparison of a safer investment versus a riskier investment looking for higher returns like a SPAC may, that evaluation, may change.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
Now, what's the advantage of a SPAC, of being acquired by a SPAC from a company that ends up being acquired by them? Well, there's a few things. Number one, it sort of helps you skip a step, meaning that many companies will raise that last round of capital. They'll do the friends and family and maybe the angel investors in the Series A and Series B, et cetera, go through the typical financing stages and, raise the last, round of capital before they then have to go public. Well, in order to go public as an operating company, it's a very complex structure. There's a roadshow, you're raising the money, you're doing all the filings with the SEC, there's a lot of disclosures and that kind of stuff. Well, when you get acquired by a SPAC, the SPAC's already public. And not that there's not some filings that have to be done, but it's much more simple, comparatively, it's less complex. And by getting acquired, you basically, you become public, without having to file for your own IPO. Now, some people might have heard a concept of, shell. There are these shell companies that, are public that, whether they stop operating, gone out of business, and sometimes a company will merge into a public shell. The difference between that is that the public shell, you really got to be worried about past liabilities that might come up. You have to do real due diligence on how clean the shell is. There's a history there, usually trading at low dollar amounts. This, SPAC is, something that's, very professionally formed, managed for the sole purpose of doing an acquisition, is 100% clean because it hasn't done anything before it acquires your company. So there is that opportunity to get into, merge into a clean vehicle, sort of make it easy to hit the public markets and, tap that capital that's available from a SPAC. So, it's going to be interesting to see. I mean, I've heard even in the wealth management space where there's been a lot of new private equity and things like that coming into the space over the last number of years, there's some SPACs looking around. They've hit many other industries, as well. And, it's sort of the hot new structure. Now, not really new. Like I said, it's been around 20 years, but it's become the hot structure lately, at least. It's been, in terms of the volume, that has been using, that it's occurred. Major players, people like, Bill Ackman, who's a billionaire hedge fund manager. He raised a SPAC, $4 billion in July of 2020. Major people are raising significant capital through these SPACs. So, what does that mean? Well, who knows? I mean, this thing could be the greatest thing for a while, or maybe it's a opportunity in the market right now. Or listen, or maybe like anything else, it's getting overheated, right? When everybody runs into a particular area and raises, money like that. Well, who knows whether the buying decisions are going to be made right. I read a statistic somewhere that the majority of the SPAC acquired companies in 2015 and 16 are not making money yet. So, 4 or 5 years later, not making money. Now, some of that is because some of these investments are going into sort of new technology that has a lot of R&D and upfront costs and slower, turn time in terms of getting to profitability. So, you may say, hey, some of that is, is on track, but, maybe that is, a cautionary sign. So it's an interesting thing to look at. It's not the kind of thing that the average person is going to have access to or invest in if you don't have significant investable assets likely. And it's also not the kind of vehicle that if you run some, really, small, company that a SPAC is going to become interested in acquiring your, $1 million business. But if you run a more significant, even mid-market company, it doesn't have to be huge. One of the potential acquirers, in all the acquirers, including financial buyers, strategic buyers, things like that, may potentially be these SPACs. They're worth watching and checking out. So again, special purpose acquisition corporation, formed for the purpose solely, blank check, invested in and brought public prior to doing any acquisitions, normally 2 years to acquire a company, or else you get your money back. Once they acquire the company, then, you're basically invested for the, period of time that the company's there. And, really what you're betting on is that the founders, the promoters, et cetera, are going to make the right decisions and buy the right companies and use the capital wisely. But it's interesting how they've really taken off. A little uptick in 2019 and an explosion in 2020. We'll be monitoring them in 2021. There are some predictions that volumes in 2021 will be as active. There's a quote from Citi's co-head of equity capital for the northern markets, who said it's let me see if I have his name, Paul Abraham Zeta. I hope I'm not butchering. I may be butchering his name, but in any case, he thinks that SPAC volumes will be as active in 2021 as they have been in 2020. But he says if rates stay where they are. So that's a key point. If rates stay where they are, the other factor, of course, is the market. So interesting to follow. We'll be following them. Check them out. A lot of information out there on SPACs nowadays. I'm always interested in become more popularized, approaches for doing deals and for raising capital. And certainly, SPACs are hot right now. All right, folks, I'll see you next week.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up, For the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.